what auditing, what the principles of auditing is all about. And perhaps the most important thing, these are my names, you'll meet them as we go on. And I want to confirm whether you have received the course outline on Teams. Have you seen the file on the course outline?
Yes, sir.
Thank you.
Yes, sir.
Okay, thank you. So we proceed and just try and get an overview. We'll spend today and Friday trying to get the introductions right. Then as we slowly will dwell into the matters. I think what is critical for you to understand at this point is that we have two major fields of accounting, which is the financial accounting and auditing. You from your past, you have learned that financial accounting is the recording and of financial transactions, classifying them and summarizing them, and you have properly concluded your preliminary knowledge of financial accounting with producing those income statement and balance sheets that were not balancing, and you probably did the cash flow. And as you grow older, they will introduce you to other methods of summarizing financial statements. You'll notice that going forward for yourselves in terms of financial accounting, you'll be concentrating on the complexities of summarizing financial information, acquainting yourself deeper with the accounting standards is what is amiss. I don't know what at year 3, what financial accounting, what's the name of your financial accounting course that you are doing at year 3? Anyone? Are you there? At least
Yes.
you should be doing a financial accounting course at year 3. What is its name? I don't know. What? 3 or what? Anyway, the matter is, yeah.
It's FIN 301, Financial Markets and Institutions.
And you don't have an accounting course?
We do.
Accounting 311.
And what do you call, what is its proper name?
ACC 311.
What is its description? Is it what they call it? Accounting for what? Company account. Oh, that's one. That's why company accounts. Now you will be learning how to summarize financial statements for the company. Exactly what in the majority of cases will be audited. You'll notice now you are learning how to summarize financial statements for the company. Summarize means agree you recorded during ACC 100. Then you classified during ACC 100. You started summarizing accounting for manufacturing during ACC 206. You are at 30311. Now you are summarizing again. That summarizing means preparing financial statements as a company so that you make them ready for auditing. Yes, that is summarizing. Then I said, then we bring in the element of auditing. The element of auditing concentrates entirely on establishing whether in your recording and classifying and summarizing of the financial records in financial transaction, did you do it in accordance with the set criteria, the generally accepted accounting practices, GAAP? The generally accepted accounting practices are international financial reporting standards. We're saying everything in accounting is standardized, and you must know that it's standardized, and there is a unique way. There is a unique way of recording financial accounting transactions in the books, and that unique way is described in general accounting accepted as GAAP and IFRS. That's the unique, and that is what we call the criterion. So auditing is accumulation and evaluation of evidence. You go through the financial reports that have been produced by management through you as the finance manager, and you look for evidence in that information. What do we mean that information? We mean the financial statements and the transactions and the results of feedback you are getting from interviewing staff. And you look for that evidence, you accumulate enough, and you look at the evidence, and you say, with this evidence that I have collected from these financial reports, this evidence, does it show that these financial reports were prepared in accordance with the generally accepted accounting practices, in accordance with all the criteria that has been set beforehand? So when you record financial statements, you must have criteria, standards that are set beforehand. So that at the end of the financial year, when the auditors come, their job is to accumulate evidence, then I'll evaluate it, evaluated against the set criteria to say that is this evidence, does it show that the evidence that I accumulate, that means evidence will just be a sample out of this evidence will just be a sample out of the numerous transactions that you conducted during the last 12 months to give me a feel as to whether this information that you prepared, is it in accordance with the criteria, and the criteria we said are the IFRS. So the question now is, in our definition of an audit, is what is an audit? An audit is an independent examination of financial information. As we examine the financial information, we collect, accumulate, and evaluate evidence. Why do we do an audit? We do an audit because we want to express an opinion, to give a feel to users of the financial statements as to how much has this process of preparing the financial information, how much was it done in accordance with the generally accepted accounting practices, or IFRS. We give a third party, the workers, the government, that yes, this management, that the shareholders, that yes, this management that you left produced a record of how the business performed. With us as auditors, we are giving you a reasonable, not an absolute, a reasonable assurance that these records were prepared in accordance with the method that has been prescribed, which are the IFRS of the general accounting. And when is the audit performed? The audit is performed at the end of the financial year on the financial statements that have been prepared by the management. In a company structure, are you there? If in a company structure,
you're present.
Yes, in a company structure, we have what we call the governance structure. A shareholder establishes a company. He registers a company. Then after registering a company, he sets up what is called a board of directors. Directors are people who have been engaged by the shareholder to run the company. Then the directors then engage what we call executive management. Executive management is the chief executive officer, the finance person, the person who is head of operations, the first person who is the chief financial officer is the first employee who has been employed by the directors to run the company on a daily basis. So there are three layers. The first layer is the shareholders. The second layer is the directors. The third layer is the executive. The executive, they get told what to do by the directors. The directors the directors are engaged by the shareholder to say, I've invested in this company. I'm looking for people who will oversee it so that I have a return of 20% of profit. So that's the governance structure. So it is the executive management, that is the CEO and his people who work on a day-to-day basis, who produces the financial statements. And after producing the financial statements, they report to the board of directors, which is the board, and the auditor comes in to tell the board that yes, these accounts are prepared in accordance with the general accepted accounting principles, and he gives an opinion. His opinion is important. The opinion simply says, yes, I am agreement that they were prepared in accordance with the general accepted accounting principles. We will discuss the opinion next week sometime. The types of opinions that the auditor can give. So that so what is important here to emphasize that the auditors do not prepare reports. They're independent. We said they're independent. They're out from outside the company. So there are two kinds of auditors, just to clarify. There is the internal auditor and the external auditor. When I refer to the word auditor here, I'm talking about the external because his independence. The firms that are external auditors are the big five, the Deloitte, Ernst & Young, Coopers, and those are the firms that are external auditor. An internal auditor is also an auditor who is working inside. He's part of the management. He's working inside the company to check if there is compliance on a day-to-day basis with general accepted accounting or IFRS, and advises management that they must comply. So he makes the job of the external auditor much easier because he would have looked at the records every day. When the external auditor comes, he asks the internal auditor, how are these guys doing with respect to compliance with the criteria? Then the internal auditor will tell him, no, yes, they are good or they are bad. But this does not absolve the external auditor from also checking, because he's the one who has to express an opinion on the financial statements. Who can do the audit is the next question that we must deal with. Oh, come on. Who can do the audit? The audit has to be an independent external, it can be done by an independent external professional. And that independent external professional, as soon as I use the word external, that means that person cannot be an employee of the company or a company related, any related company. Any company that is owned, has shares, and cannot be cannot be an external professional in this particular case. The person who can do it must be certified by a professional body. He must have a qualification, BICA, ACCA, whatever qualification that you have. You must have been passed and passed the international exams, and that certifying body must have said you are technically competent to be an audit. Are you there?
Yes, sir.
Yeah.
Yes, sir. Yes, sir.
Yes. So this person has to be the other characteristic of this independent external person who can do the audit. He must not have any personal relationship with those charged with executive management or governance. I just described governance, shareholder, a board of directors, and executive management. Executive means employed management. Executive, if you hear the word executive director, that means that director also works in the company. The word executive here means employed, goes there. He gets a salary as an employee. He also has another contract of employment. Governance means the board of directors and the board of directors, shareholder board of directors, and the executive management. There must be no relationship, so no personal relationship with those charged. So if my wife, my daughter, my whatever is working for the company that we are going, is working for the auditors, it cannot be an auditor to to that because there is a personal relationship. No financial interest. You cannot be a shareholder, a creditor, a debt holder. You must be independent from the company you are auditing. So these are not employed by a related company. So you should not be working for you to be an independent external auditor. So we are looking for a person who's 101% neutral to give an opinion about whether or not the company that we are looking at has complied with the general accepted accounting principles. Are you there?
Yes, sir.
The important thing here is that there is a verified is in a verifiable to do an audit. There must be information in a verifiable form. The information must be in the form that is prescribed, and there must be standards about how that form has been arrived at, and these are the standards that happen. International Accounting Standards Board, Financial Accounting Standard Board. These are the standards that you learn that that prescribe how the form should be and what is the criteria. I just repeat here the competency and the independence of the person who he must be competent. Competency here, we mean certified. That is where, like I said previously, that is where we are lacking in this country. I think we have about 50, 60 people, 50, 60 people in the audit firms, accountants in the audit firms now. And they are still not, they are qualified, but they are not competent enough according to the market to be partners. Although I am struggling with agreeing to that as a citizen. I am struggling with agreeing to that I'm trying to agree to the assertion by the market that after these many years of qualifying accountants, we hardly have more than 5 or more than 10 audit partners, local audit partners. That I'm struggling with agreeing with that. I'm a proponent of market forces, and my view is that it looks like the market has failed to deliver partners in the country, citizen partners. And where a market is unable to deliver any product, the demand and supply is unable to deliver anything in the product, there is likely to be collusion or someone interfering with the market behind the scenes. So when there are things like that, the reason why our economy is a mixed economy, we need to, those put in the power, we need to intervene. We need to intervene. That's why it's called a mixed economy. We need to come with government regulation and prescribe that the market should produce competent partners. Are you there?
We are here.
Yes,
Yes.
I am of the contention that we need to intervene, because if you look at South Africa, over 90% of the partners are South Africans. Namibia, same story. Zimbabwe, same story. And if you look at the manner in which the government has intervened in the process was through legislation, where the government prescribed that you are not going to register an audit firm unless you are a local, or there's a certain reserved proportion of locals to be partners. So most of the unique thing about life is that if you are put in a position of privilege, you generally cannot give favor to a disadvantaged guy until he forces you to give him favor. So that's my take on that. So what I'm saying is that we, as the markets projects now, there are not enough competent Botswana to be partners. But I disagree with the contention by the market. You can find independence is not a problem. For them to be able to judge, to evaluate the evidence, they have to be very experienced to be able to evaluate it. Then they conclude and come out with an opinion as to whether indeed the financial statements were prepared in accordance to the prescribed criteria. I think what is critical is that during the audit process, as we move forward, you'll notice that we shall be talking more about this term, evidence. Are you seeing my mouse? We shall be talking about this term, evidence.
Yes, sir. Yes, sir. We see the mouse.
This will be the what do you call it? The life and death of an auditor. Everything that the auditor does, he must accumulate evidence, enough evidence. Then the word enough is relative. He must accumulate evidence and show us how he collected the evidence from the 101 transactions that he's going to be looking at, because we give the auditor only 2 weeks. Then he must evaluate that evidence from the transactions, from clients' testimony, from written submissions by the client, from observation by the he's getting evidence through transactions, through clients, interviewing clients, through written submissions or by outsiders, that means confirmations, through observing people as they work on a day-to-day basis. He will be using these sources of evidence and evaluating them to give us an evaluate to make a determination as to whether the information that was produced by the management, was it in accordance with the criteria. He's using all these testimony from clients and from employees, transactions. He checks through transactions, and he writes he gets written confirmations from outsiders. And he observes as people work on a day-to-day basis, or he goes and inspects and observes to see inspections. And that is his method of collecting evidence. After accumulating that evidence, he must evaluate it. And when he evaluates it, the opinion he's giving us is whether or not the information that has been presented by management is in accordance with the established criteria, which would have been agreed at the beginning of the audit. In this particular case, there are already rules that have been put in place, that when you prepare financial statements, you have to have creditors, you have to have what. This is the established criteria, which is the IFRS. After that, then the auditor produces what is called an audit report. First, what is critical, we are still going to come back to here, is this in this way. Also, in our opinion, such financial statement schedule, when considered in relation to the basic consolidated financials taken as a whole, presents a fairly, in all material respects, the information set forth herein. We will discuss the opinions with that. He produces a report like that, then he signs. This report is the life and death of the audit, to say that the information that his evaluation of the information based on the evidence he collected in the company, it represents a fair, reasonable, is reasonably accurate in all material respect, and such that this information could be relied upon. That is what external parties are looking at. That is what everyone is waiting for, an audit report, an expression of an opinion by an independent person after examining the financial information and the records, interviewing and whatever. The expression of an opinion after examining the transactions, getting a client testimony, looking at confirmations, making observations, and examine and he will give us a feel as whether the information as presented by management has been prepared in accordance with established criteria. That's what we are looking for. If he doesn't do a good job and does not produce produces a report that is flawed, remember, everyone is looking for at least an unmodified. We'll come to that. This report is the one that everyone is looking. Every company that is being audited is looking for a report that says that they've produced this financial information in accordance with the set criteria. So this information is going to be used by all stakeholders. It's going to be used by the banks. It's going to be used by the taxmen. It's going to be used by investors. It's going to be used by the union. It's going to be used by everyone. As soon as he says it should be relied on, then everyone is going to rely on it, and the users are going to use this information because this report was produced as confirming that we can fairly depend on the information produced by management. Remember, management by nature is conflicted. Are you there?
We are here.
Yes, sir.
Management by nature, there's what is the agency theory. Remember the agency theory. Have you heard of that theory? The agency theory. The conflict between management and the shareholders, the board, which are combined with management and the shareholders. This is what the theory says. Management and the board of directors they're also paid well through sitting allowances and all sorts of things. Management, the CEO and his chief financial officer, they're paid fairly well. The shareholder on the other side wants to pay management because the shareholder management pays itself from profit that was supposed to go to the shareholder. So you must understand that management pays from money that was supposed to have been declared as dividend. So the management is conflicted. On the other side, management has to maximize the profits of the shareholder. On the other side, at a personal level, they have to pay themselves enough. So when when there is a quarrel about a salary increase, there is a conflict there. Management wants, personally, they want a salary increase. But if they increase their salaries, that means the shareholder is going to get less dividend. Do you understand? If they increase their salaries, there's going to be less profit. And when there's less profit, the owner of the company gets less money, assuming the profit is cash. If they increase their salaries, the shareholder is going to get less. So because of that, there's an inherent conflict in management. Because of that, there's inherent conflict in management, in the executive and the board. The executive of the board, they want the beautiful perks, and as they do that, they also need to satisfy the shareholder with profit. So you find that decisions are tricky for management. If they agree to take lower salaries and impress the shareholder, then they are disadvantaged. So it is always a non-starter when the union negotiate. Let's take the case of the University of Botswana. Recently, there was a strike with the lecturers. Were you there? The lecturers were on strike, wanting a salary increase.
Yes, we were there.
Yeah.
We saw.
Yeah.
Yes.
So they are negotiating with the vice chancellor. Is management staff against management, but that's neither here nor there. The staff wants a salary increase. They want an 8%. If they get an 8% from the vice chancellor, the vice chancellor also get an 8%. Would you say that the vice chancellor was speaking on behalf of the shareholder? Two guys are saying 8%. The union comes and says we want a salary increase of 8%, and the vice chancellor says no. At the back of mind, he knows if I say yes, I'm also getting the 8%. Is he independent?
No.
He's not independent.
He's not independent. Hey, can he be seriously to be said to be speaking on behalf of the shareholder when he knows he can also benefit? He's likely to say to the shareholder, I think the 8% is okay, we can survive with it, because he knows personally he also gets the 8%, but that may not be in the interest of the shareholder. You understand the conflict there. So the board and management left alone will rob the shareholder. Isn't that true?
Is
So we need a third party. Who is the auditor? To check from the whole governance structure of the board to the financial information. Remember, this financial information, that the financial statements that is produced by management is going to be presented to the shareholder by the board of directors, by the directors. But these directors are also paid from the same the directors' fees. So we need to have a third party who is independent of the board of directors, who is independent of management, who can tell the shareholders clearly that these people are they're crooking you. They're inflating the salaries, and also you must understand that shareholders are outside the company. They will not know about what is happening on a day-to-day basis. The board of directors are also outside the company. They will not know, but at least they meet 4 times a year at a board meeting to be told how the company is being run by the executive management. They're better than the shareholders. The shareholders, they meet with the directors once a year at an annual general meeting. You understand the structures?
Yes, sir.
Good. So, so we proceed and said, therefore, inherently, there's that conflict. But why do we need an audit? First, I mentioned the conflict that we have. The conflict is we have. The conflict, yeah, that we mean. Secondly, is that there is always a risk of the information risk. Information risk, I'm saying, the risk that the financial statements that have been presented to us are wrong. This information, because you must understand that we are referring to the financial statements. What we mean by the financial statements, we mean the income statement, we mean the balance sheet, we mean the cash flow statement, a statement of equity, we mean the accounting policies, we mean the disclosures, we mean all related information that was disclosed to us that relate to this. Because there's risk that information, there's risk that information is not correct. What causes that? What causes the risk? The risk that the information in this particular instance, I mean the financial records, that these financial records are incorrect. The remoteness of information. What we're referring to there is that financial information by nature is produced by other people. And when it's produced by other people, you need to establish whether it's correct. The fact that it's produced by other people is remote from the users. So there's always a risk that it can be falsified. So it needs to be verified. You need a third party to verify the information, because it's produced remotely, and you have to. What causes a financial information? Increases the risk of financial this information. What increases the risk that it may be flawed is because it's produced by third parties, which is management. And as it's produced by third parties, you cannot just blindly rely on it. It needs to be verified, because it's produced remotely from you as the user. The second cause of increased, what causes information risk is that because it's produced by different people, those people may have their own biases and motives of providing falsifies information. If the person who's producing the information is under any pressure, he's likely to bias the information to resolve their pressure. So that is the reason why what causes the information to be risky is because it has there's a propensity that it is biased, and people who are producing it have ulterior motives. So you need a third party to look at it, to try and identify whether there was bias or ulterior motives that could have forced the producers of this information to gravitate towards presenting a certain position, which is not perhaps as true as one would have thought. The fourth is that by nature, this information is of massive volumes. You see, Choppies, it has a turnover of 4-5 billion. Sales are happening in 100 and something shops, and there's a massive volume of transactions. So you need a third party to check whether, given the volumes and the incredible volumes, that is there, what can I say? As a user, I need to, there's a risk that the information is wrong. The voluminousness of the information scares me as a user. So I need a third party to check whether the information, the method in which the information is being produced is in such a way that the summaries that are going to be produced can be dependent on. In today's world, there are a lot of complex transactions that require a complex double entry to be the derivatives and debt instruments that are there. You need a third party to check whether, to give an assurance that those complex transactions have been properly accounted for. What causes us to be suspicious that the records could be wrong is that they are produced by third parties. Therefore, because they are produced by third parties, which means management, therefore, any user must have a fallback position for someone to verify that information on his bar. That by nature, people may be biased or may have motives in providing the information. So we also need a third party to verify that this information that is produced is free of bias and some motives that may not be of good intent. By nature, this information is produced in large volumes from data that is of large volumes. The data that has large volumes of invoices, cash transactions, it's always suspicious that there could be error. So we need a third party to establish whether the environment in which this data was being handled was such that it can produce information that is dependable. By nature, this information, this data sometimes requires complex transactions, double entries, estimates and measurements. It's things like you need to value, for instance, if you are producing financial statements of a mine, you need to tell us whether there is how much ore is left in the mine, and when you are going to be giving an opinion about whether there is still the life expectancy of the mine, whether the business still has a going concern will depend whether there's still a life expectancy. What's the life expectancy of the mine? These are complex transactions that may need specialists to look at that. We need to be assured that the auditor has ensured that some of these estimates have been reviewed by specialists who are competent in that. How do we reducing information risk? Yes. The user must verify information. In this particular instance, very few users are able to verify the information themselves because of capacity and because of lack of competence in verifying the information. You may have the BRS sometimes when they are given tax records, they have the skills to verify. They have inspectors and auditors, tax auditors who can verify, but they will be concentrating on tax matters. But with me and you, when we are given financial statements, there is no way in which we can verify that the information, the financial information is correct or not. That's why we use auditors to do that. So sometimes we share information risk with management. Where we share information risk with management, you will notice that in other boards we have management that we also include in the executive. We include them in the executive because we want to share, so that when we include management in the board. So you have board members who are called executive directors. When we come to that, a board member has what is called a personal risks to, he has personal risks to financial information. This is what we mean. If accounting records are found to be false, board members can be sued personally. Then I can sue you in your own name. But employees that are sued in their capacity as employees. So you sue the company for producing financial statements. So you don't sue employees personally. So they can be let go in the event of a massive lawsuit. So this is what happens. Let's say that water utilities decides to pump sewage into drinking water, and a lot of people die out of cholera, or some idiot decides to pump sewage into drinking water. The directors, if they were found to have been negligent and were made aware of the risk of that happening, and when they were coming to board meetings, they ignored that, we can sue them personally for having misled the shareholders and the stakeholders. That is why it is the directors' positions are very, very risky positions, because you can be sued personally. For employees cannot be sued personally because they are working on behalf of directors. They've been employed on the behalf of the CEO, and so they're agents.
You are muted.
Can you hear me?
Yes.
Where did I stop?
Yes, we can.
Where did I stop?
2 minutes ago.
2 minutes ago. So we are talking about ways in which information risk, the risk that financial statements may be wrong and we get misled, is either we verify itself, or we get managers to be part of the risk profile. We'll discuss this later in governance, or whether we audit the financial statements. The audited financial statements are we use audited financial statements. That means we reduce the risk because we share the risk with the auditors. Yes, this is a relationship. We have the auditors here that are, and we have external users. The function of the auditor is to assure external users that the records provided provided can be relied on. It is the client or the company that provide financial statements to the users. These are all the stakeholders, the government, and all sorts of things. the auditor issues a report to say that, yes, users, I looked at the client's information and I'm reasonably assured that you can use that information to assess the client, whether you want to deal with the client by providing capital, or you want to get a job from the client because you think he's making a lot of money, or whether you are a bank, you want to lend money to the client. You can reasonably depend on the financial statements. So this auditor is an extremely important person. He's giving an assurance that we can depend on the financial statements as provided by the client. So audited, that's why you go to any environment, they will say, bring audited financial statements. That means that they need an independent person who has reviewed the financial statements and put his head on the block to say, I think the financial statements were properly produced, so you can rely on them when you are making whatever decisions you want to make to deal with the client. So that is the relationship between the auditors, the client, and the external use. The client, in this case, we are going to be using this term to refer to the company that is being audited. External users, we mean stakeholders, government, employees, tax, whatever, who's going to be using who can be injured by using including yourself. You may decide to take a job with the client after looking at the financial statement, only to be told that the financial statements were wrong. Then you left your good job to go and get a job to a guy who is not making money. So we stop here, ladies and gentlemen. On Friday, we meet again and we try to continue where we are living. So I take it that on Friday, I'll try and post the slides, but I'm still improving on the slides. As I get another perspective, we'll discuss the audit reports and the opinions that the auditor can produce, and we'll slowly go into it, slow by slow. Thank you very much. I take it if you still have not been added, you can send me an email and I can add you. Yes. Any issues?
Please share this slide, Jason.
Yeah, I'll do that. I'll do that. I'll try and do that today. Thank you very much, ladies and gentlemen. Let's call it a day.
Thank you, sir.
Bye, sir.
Bye-bye.
Good night.